Are you aware of how the passive income tax rule in Canada is affecting you as an incorporated business owner? Hi, I'm Dave, and I help make Canadian business owners' goals a reality with innovative financial advice. Before we get into the taxes, let us first define active and passive income. The income from what you actively do in your business is active income. Let's say you own a gym. Active income is any income you earn from selling gym memberships, personal training packages, or retail like workout gear. Now, any income that isn't a direct result of what your business does is passive income. You do not need to actively participate to earn passive income. If you take the profit from all the gym's active sources of income and buy 1,000 shares of Amazon, the gain you make from selling the Amazon stock is passive income. Passive income can also be from things like real estate. Usually, business owners start investing in passive sources of income when they are making a profit above what they need to pay themselves and other shareholders, or when there is extra cash inside the business that isn't needed for operating expenses. Understanding how passive income is taxed and what your investment options are before you start investing will make a big difference in how quickly you reach your goals. Now let's get into how the passive income tax rule is affecting business owners. Corporate active and passive income are taxed differently. Passive income has a tax rate close to 50%. With active income, the first $500,000 of active income earned by a Canadian-controlled private corporation qualifies for what is known as a small business deduction, which has a lower tax rate of 9 to 12%, varying by province. Any active income above $500,000 is taxed at 25 to 27%. But this is where the passive income tax rule comes in. This is also where it starts getting a little more complicated, so bear with me here. If you're making over $50,000 a year in passive income inside your operating company or your holding company, for example, from rental income or investment income, this will impact how much of your active income qualifies for the small business deduction. The passive income rule states that every dollar over $50,000 earned in passive income per year, you lose $5 of your small business deduction. For example, if you earned $90,000 in passive income this year from rental income properties, $50,000 will not affect your small business deduction. However, for every dollar exceeding $50,000, you will lose 5 times that amount on your small business deduction. In this example, that's $40,000, and 5 times $40,000 is $200,000, which will be the amount taken off your small business deduction. Now, instead of the full $500,000 qualifying for the small business deduction, only $300,000 qualifies. This means you would pay 11% tax on the first $300,000 and 27% tax on the rest. Essentially, the government is saying since you earned more than $50,000 in passive income, they're going to reduce your small business deduction and tax you more. Now that you're aware of how the passive income tax rule can affect your active business income and increase taxes, let's talk about how to invest tax efficiently inside your holding company to keep as much money in your pockets and out of CRA's hands. Number 1, invest in capital gains producing vehicles such as stocks, real estate, or corporate class funds. 50% of capital gains can be drawn out tax-free using your capital dividend account, meaning only half of the capital gain is taxed. For example, if you had $80,000 capital gain this year from selling stocks, half of that gain can be paid out tax-free through your capital dividend account. Now you're left with $40,000 in passive income, keeping you under the passive income tax threshold of $50,000. Number 2, invest in a corporately owned exempt whole life insurance policy and benefit from the tax-deferred growth in the value of the investments. The growth of the policy does not impact your small business deduction. For example, if you invest $100,000 a year into an exempt whole life insurance policy for 10 years, every dollar of growth would not be taxed, meaning your small business deduction would not be affected. One strategy involving whole life insurance is to overfund your life insurance, meaning paying more than what you need to monthly or annually for your premium. This further increases your tax-free corporate investment. Finally, make use of your capital dividend account. Your capital dividend account allows you to flow the untaxed portion of capital gains and life insurance proceeds out of your corporation tax-free. Make sure your corporate passive income strategy is structured tax efficiently so your money stays with you and your family to allocate towards your biggest goals. Thank you for watching. Hit the subscribe button and the bell icon to get notified when new content is uploaded. If you're interested in learning more, we have another video for you. Click here to take a look.